Kyle is with us in New York. Hi, Kyle. Welcome to the Dave Ramsey Show.
Hey, Dave. How you doing?
Better than I deserve. What's up?
Hey, so I'm a real estate guy. I got my license shortly after you did. I was 22 when I got my real estate license, and I've been in the business about 14 years. Heavy on the investment side. I'm at rental portfolio that's about $3.5 million net worth, about a 68% equity position in it. And I did a calculation. I'm sort of relatively new fan, and I appreciate all the stuff you're putting out there. And so I did a calculation to figure out what it would actually take if I used all of the cash flow to point right at the debt, how long it would take to actually pay all of it off, which I came out to about 10 years and 3 months. But I guess my question is value in doing that versus value on continuing to use the cash flow to grow the portfolio, which to date is basically what I've been doing.
Yeah, okay. So you've got a top-line asset base of $3.5 million, not net worth.
Correct. Yeah.
Okay.
Total portfolio value is 3.55. Okay. Equity is 1.132.
So what do you got? 14, 15 properties?
Right about there. Yep.
Yeah. Okay. Cool. Good for you. Well done. Very well done. And you're in a 70% equity position, meaning you only have 30% of it in debt. So less than $1 million in debt.
No, reversed.
Oh.
So 68% leverage.
Oh. Okay. So you don't have a ton of cash flow.
It's about monthly after all expenses, mortgages, CapEx, everything is around $7,700 a month.
Yeah, that's not much. Okay, that's what I thought. I thought it was tight. I mean, $7,700 a month is a lot of money, but not on $3.5 million. It's not. So that's yeah. Okay, here's the thing. You said you're new to all this. Here's what I went through. We had about $4 million worth of real estate and owed about $3 million on it. So we're in about a 75% ratio. Some of that, a percentage of that, probably $1 million of that was on 90-day notes because we were doing flips. Okay? This is back in the 80s, way back. Okay? And I was in my 20s. I had grown that from nothing in just a few years, and so I leveraged into every bit of it, obviously, but I did good buys like you have done, which gave me strong equity positions, and so, I was at about the same LTV you're sitting at, roughly, and a little higher, but I had a higher risk position because of the 90-day notes and the flips, which is actually what took me out. That's what broke me, because the banks called the notes on the 90-day notes. The bank got sold, and the new bank freaked out when they looked over and saw a kid in his 20s that owed $1 million. And so the new guy freaked out, and that started a tumble that I couldn't recover from. And so what I learned from that process was a lot of things, of course. But as a real estate guy, one real estate guy to another real estate guy, I learned that... Well, let me stop a second, okay? I also got a finance degree, and in the process of getting the finance degree, we were taught in other investments to not measure risk investments with high-risk investments with low-risk investments apples to apples, meaning an example would be an aggressive growth stock mutual fund, which is much more volatile than a growth and income mutual fund, okay? You wouldn't compare it making a 20% rate of return with a growth and income making a 10% rate of return, apples to apples, and say, oh, we're going to discount, we're not going to consider risk, we're just going to go with the 20%, the higher rate of return. Because when you consider risk, you equalize out those two funds, the lower risk and the higher risk. You have to mathematically put the risk in. And in that world, there's a way to mathematically insert risk. It's called a beta, and it's a statistical measure of risk, the volatility of the hills and valleys if you chart it, and all of that, okay? So all of that to say is there's actually a math formula that you can use when comparing two investments of that type, because the beta is stated by the mutual fund company. It's a volatility index. And long story short, you can adjust for risk so you can compare a high-risk investment with a low-risk investment, apples to apples. Does that make sense?
Sure.
Okay. Now, having said that, then when I went broke in the real estate business, I suddenly realized that in the real estate business, which I grew up in, we are not taught risk at all. We're just taught it's all leverage and it's all good all the time. But common sense tells you the more leverage you have, the higher leveraged you are. Meaning if you had a 90% leverage position instead of a 68% leverage position, you would be at a higher risk. Agreed?
Right.
But we don't adjust for that.
Correct.
And if you had a 100% paid for real estate portfolio, your risk would have dissipated like light years from where you are today. Agreed?
Sure, yep.
And yet we're not taught to mathematically adjust for that. All we're taught to do is go, well, let's take the cash flow, buy more real estate. Let's go in debt some more. We do not adjust for the risk of leverage in the world that you and I are in, okay? We're not taught that. Nobody does. And so that leads us to a faulty presumption that risk isn't there, and so we just go buy stuff on debt. And you would always take, I mean, what kind of fool wouldn't have debt on real estate? And we just go buy real estate. And that's what I did for years and what I believed for years, because I was not taught academically, and no one in academics that I've ever found, I've never found anyone who actually applies a risk formula to the leverage issue in real estate. But it's there. We know it's there from common sense. All of that babbling to say, I came to the conclusion, and I've actually run some pretty sophisticated math models I developed myself because I'm a math nerd, that shows that paid-for real estate will prosper you. A smaller portfolio of paid-for real estate will prosper you more than a large portfolio of leveraged real estate over the span of 20 years. Okay? And so high leverage guys, nothing down guys, all those guys that have gone broke, I knew a bunch of those guys back in the day. I don't know any of them made it 10 years. They all crashed within 10 years. Super high leverage. You're not that guy, okay? But the nothing down crowd. You know what I'm talking about, right?
Yeah. Well, I mean, in all fairness and disclosure, I mean, I started it with 17 grand probably, and then we've kind of just rolled up, pulled the equity out, bought the next one, fixed it up.
Exactly.
Spent the money wisely, but it's all going right back into the same
exactly.
The same pool.
And if you look at 7,700 flow on what you got, it's not that great.
Right.
You don't have that much movement for the amount of money you are controlling and manipulating every day.
And this is also a side business. I mean, that's not my primary income by any means.
I think how you got there, I'm not going to be mad about. I'm just glad you're there. Congratulations. You've done great. If I'm you, I'm going to dial down that risk for my long-term stability. I would rather own less real estate that is working towards getting it paid for. So I might cherry pick the portfolio and keep the ones I really want to hold 20 years, and some of these others that I'm not that thrilled about, I might flip the equity out of those towards debt reduction. I might go the other way. Matter of fact, I know I would. All of my real estate's paid for, and I pay cash for all of it, and I got a bunch of it. Hey, man, thanks for the discussion.